I am excited to share about an educational little presentation here about using strategic debt and really specifically accretive leverage. I'll jump in here to a little bit about my background. Spoiler alert, I do not have any experience on radio. I've been working in single family residential for nearly 25 years. I started in construction. One of the first things I did after completing my undergraduate degree was start a construction management business where I provided services to luxury spec developers. I worked to get my MBA at night during that time. When I completed my MBA program, I moved on to work with a production home builder, Richmond American Homes. When the market started to move away from home building, I had the opportunity to join the CMBS securitization group at Countrywide. Yeah, I can see all the reactions on everybody's face. Yes, Countrywide. Turned out to be a little different than what I expected, as I essentially had front row seats for financial meltdown. It was a great experience, though, nonetheless. Up to that point in my career, I had primarily been focused on physical real estate operations. Working in CMBS securitization provided me with an opportunity to tap into my math background, though, and provided an exposure to analytics as well as Wall Street caliber pricing models. As the market progressed through the downturn, I moved on to an analytics role with $1 billion MPL fund, Arch Bay Capital. I priced out billions of dollars in MPL pools in this role. When when that business transitioned away from buying new MPL pools, I moved back into the real estate operations side of the business in asset management. In this role, I spent a year traveling to all the markets where we had major concentrations of REO, and this enabled me to develop a nationwide broker network. That broker network was one of the most valuable things I brought with me into the next phase of my career that I'm still in today and have been for over a decade. I guess it's 12 years or more now. As an operations executive in single family rental, I have built and managed portfolios for several platforms. I built an 1,100 property workforce housing portfolio for a family office. And for the past 6 years, I've had a role as the COO of an institutional acquisitions platform, Fortune Acquisitions. During my time with this platform, we've bought over 3,000 houses and deployed, I think we just cracked 700 million in acquisitions capital. One of our core clients in that business is a large private equity fund. And as we have bought nearly 2,000 homes for this fund, um, in I should stop there and say that this fund is they're what we call a traditional institutional SFR buyer, in that they're really only buying down to a 1980, and that's even changed a 1980 year built. That's even changed a little bit since interest rates have moved, in that some of the public REITs and some of these other larger buyers, they're buying even newer homes. But so as we've purchased nearly 2,000 homes for this fund, I can't help but notice all the lost opportunities for discounted purchases by not buying slightly older homes. And that's really where the strategy for Homestead Affordable was born. Let's jump into our educational presentation. In 2019, I put together a presentation on accretive leverage. There I am in my presentation on accretive leverage and SFR investing. It is the icing on the cake in SFR real estate investing. It's just the icing and not the entire cake, because it won't make the investment entirely on its own. But when you have it, it sure is nice. What is accretive leverage? Accretive leverage is a loan that increases returns as the amount of the loan increases. For a simple example, if the cap rate is larger than the interest rate, you have accretive cash flow leverage. The margin of the cap rate over the interest rate increases the levered yield as more debt is used, because you're basically renting the capital at a profitable rate. To make sure we're all on the same page with some definitions here, when I say cap rate, I'm referring to the annual income of an investment without consideration of debt. Debt service is the total payment amount required to satisfy the obligation of the debt. Said another way, this is the rent required to use that debt capital. Finally, levered yield is the cap rate less debt service. divided by the equity utilized in the investment. I know I kept on going on there, a little bit of a tongue twister. Another way to look at levered yield is that it is the current cash flow segment of ROE, return on equity. Let's cover a few facts from that first presentation. Underwritten investment attributes have low volatility. Underwriting is fully under our control. While rent is driven by market activity, our assessment of that market rent is fully under our control. The purchase price probably has the least volatility in the set. A contract amendment must occur for it to change. And if we're doing things right, it should only go down. Rehab can be a little bit more tricky. There are definitely things that there's definitely things that can exist. People say behind the drywall or behind the walls that are basically unknown when we're doing our initial underwriting. But in general, we should be able to have a pretty firm grasp on what a rehab should cost before we get into a deal. Interest rates definitely have high volatility. We'll get a firsthand look at this later. And as a result, interest rates are definitely out of our control. If anybody claims, even Powell at the Fed, if he claims that he can control rates, he is not telling the truth. And the final thing that is actually under our control here is debt. And I think this is one of the main points that we want to make in this presentation today, is that debt is something that we always have full control over. A lender might cap us on the maximum amount of debt that we can use, but we can always choose to use less. And is a summary of some of the conclusions from our first presentation in 2019. Accretive leverage isn't automatic. It's conditional. To find that icing on the cake, we need to look for it. We need to be aware of market conditions and execute appropriately. Here are a couple graphs that show mortgage rate movements. Volatility is obvious here, as we mentioned before. From the low point in 2016 to the high point in early 2019, there's a 1.6% spread in rates. In that presentation, we established the accretion line. In the first presentation, we were primarily concerned with levered yield. And so the accretion line is just in relation to what our current cash flow levels would be versus the debt. The accretion line is shown as the red line in these graphs. It is the line of indifference, where an increase in debt neither helps nor hurts the levered yield. Above the line, accretive leverage doesn't exist and the levered yield goes down as debt increases. Below the line, it does exist and the levered yield increases as debt increases. Let's move on to what the lending environment looks like for SFR portfolios today. First, what's changed? Rates have moved a lot. Going into the pandemic, rates moved down and went to the absolute basement during the pandemic. At one point, the 5-year was down in the range of 50 basis points, just a half of a percentage point. This all changed dramatically in 2022 when a massive change of heart by the Fed led to an upward movement of over 4 percentage points at the peak. With higher revenue potential, being a lender has become very popular, and to the benefit of borrowers, the lending market has become very competitive. Here are a few of the most prominent portfolio lenders. These lenders originate to several very active takeouts, whole loan sales, securitization, and captive portfolio investment. The securitization exit has most prominently provided liquidity over a longer period of time, but the terms required for this exit are typically more strict. The entrance of at least one very prominent active whole loan buyer, everybody's familiar with it. It's a color, a dark color that is in reference to a rock or a stone. I'm not going to say which. But this prominent active whole loan buyer has added some flexibility to the terms as the lenders are becoming more competitive in the market. While rates have been a little difficult to deal with, the flexibility in terms have been beneficial to borrowers. Here are the typical terms of portfolio loans today. One big change is that interest-only loans are very prominent. The terms are pretty much the same. 5, 7, 10-year options and are out there based on what it is that you would matches with your investment. Prepayment penalty options, there's, at least some flexibility here. The If you're not familiar, yield maintenance is basically the act to replace. So when a lender makes a loan, they're basically selling either that loan or the bond through a securitization to another investor. Now that investor counts on that return coming from the loan payments that you're making. Prepayment penalties is a feature that a lender can use to replace that return if for some reason you decided to pay off that loan soon. So yield maintenance is I don't even know what to call it. I guess it's a product that the borrower is responsible for purchasing that replaces that yield. Typically, this is very expensive for the borrower. And I think that as you're looking into a loan, you really only want to go this route if you think that you're going to hold the loan to maturity. The other key or major type of prepayment payment penalty is a step down. So that's just like it sounds. It might be something like a 5% prepayment penalty in year one, 4% in year two, 3% year three, and so on to one until you get to the end of the life of the loan. 50% to 75% loan to value loans are pretty common for these portfolios. I'm sure you could find a lender that might go up to 80, and I think that you can always get a loan, a smaller loan. But one thing to note is that from my experience, I have not noticed that going down in LTV gives you any benefit in pricing. And a 1.2% DSCR, I think that you probably really have to dig into this and understand the underwriting to really understand what that metric actually means. Because of the large rise in rates, I think lenders have had to be more flexible in terms of their coverage, and then they'll add some creative structuring to boost this metric. But it all comes down to how they're underwriting, your cash flow. So let's take a look at how the pricing works for SFR portfolio loans. The interest rate is a result of adding the lender set spread to the treasury rate. In our examples today, we'll stay focused on a 5-year term investment and the associated 5-year treasury rate. Contrary to popular belief, the Fed doesn't actually set treasury rates. I told you, Karin, we're going to talk about it. Treasury rates are set by market activity. When more market participants want to own treasuries, the rate goes down. This happens basically because those investors want to own the bonds so much that they're willing to accept a lower rate of return. They bid the price of the bonds up, and that drives the yields down. This is commonly referred to as a flight to safety. When investors feel the market is more risky, they want their money in the safety of U.S. Treasury bonds and will pay up to achieve that. The opposite occurs when there is more confidence in the market. Investors are willing to take more risk in their investments, and the result is the flow of funds away from the safety of Treasury bonds and into higher risk investments with higher returns. The flow of funds away from treasuries results in a higher treasury rate. Rates are influenced by activities of the Fed, but not determined. People most oftenly hear about changes in the overnight rate. So, recently, Karin and I were just talking about how the Fed decided not to lower rates in their most recent meeting. When the rates that they're talking about lowering or changing at all is they're referring to the overnight rate. And that's what the Fed can directly affect. When you dig into it, they're not even actually setting the rate. They're trading securities in an effort to set that rate. Perhaps an equivalent and even larger effect the Fed can have, though, on Treasury rates is through the control of the size of its balance sheet. This is, very similar to what we were just talking about funds flow in and out of the ownership of bonds. An increase in the size of the balance sheet means the Fed is purchasing more assets and is effectively putting more funds into the market. Sale of assets removes funds from the market. When funds are more scarce, The borrowers have to pay more for funds because they are in higher demand. This drives rates up. The reverse happens when there are more funds in the market. Lenders are in less demand because of the availability of funds, and rates get driven down. Doubling down on our previous statement that interest rates have high volatility, take a look at this graph. In presentation one, we noted a 1.6% spread over 3 years. Here, in just 6 months, there's a 1.2% spread in rates. And that's even without a structural change in the rate environment. The max 5-year treasury rate over the last 12 months is 4.61%, where the min is 3.41%. Even without a major structural change in rates, there are substantial moves. This may drive strategy decisions as we consider timing of borrowing. Spreads are also a result of market activity, but are set by the lender and are far less volatile. The spread is basically a factor that the lender uses to control the profitability of their lending. Transparency of how spreads are set isn't always rampant, but generally spreads are a factor of these conditions: market risk, borrower risk, and loan structure. The one part of the spread we can affect is in our selection of the prepayment penalty. We went through kind of the different types of prepayment penalties in the last slide. Without getting into too much detail, a smaller spread is associated with yield maintenance, which can make an early payoff very expensive for a borrower. Borrowers pay a larger spread for full-term step down, i.e. 5, 4, 3, 2, 1, to make it less expensive to pay down a loan early. Factoring in all of this, the 4.02% median treasury rate plus an assumed 2.5% mid-range spread would result in an interest rate of 6.52%. How does this all affect accretive leverage? Does accretive leverage exist in today's conditions? I know this is what you are all questions you all have right now. Let's take a look at considering today's range of market cap rates from 5.5 to 6.25 for single-family rental portfolios. First off, one of the benefits of the more competitive lending environment is the availability of interest-only loans. As a result, let's set the accretion line equal to the interest rate. In the first presentation, we had to include a factor for amortization in addition to the interest rate. Let's start with the 5.5% cap rate. This one is pretty easy. Levered accretive yield just doesn't exist. It's very clear. The line is very far below where rates are. We need a substantial move down in rates to hit this range. So what does it look like at 6.25? Interesting. It hasn't worked for the last 9 or 10 months, but it did work last fall. So I don't know if anybody remembers or was aware, but there was a very dramatic and kind of quick move down around the beginning of the fall last year. And I think a lot of folks that were interested, myself included, that were working on loans or interested in getting a loan, took advantage of that lower treasury rate environment. So the conclusion is accretive leverage today is close, but not quite there. How does accretive leverage affect total return? Let's use an example SFR portfolio to walk through. In this scenario, we consider an investment in a market without any appreciation, where the execution didn't result in any embedded equity from initial rehab. In every scenario, we have negative accretive leverage. That's what I'm talking about here. I don't know if you can see my arrow, but I'm referring to this movement of higher yield at lower leverage and lower yield at higher leverage. This is interesting in the 5-year low scenario, the 6.25 cap rate investment, because we know that it is accretive from a levered yield perspective, even though we have isolated returns to just that from current cash flow. The difference here is that we are looking at IRR. This is a total return metric, and it includes the cost of sale. The result is that the cost of sale eats into the levered yield so much that it turns the investment to negative accretive yield. In this scenario, debt isn't our friend, and quite frankly, neither is this investment. This is a result of poor market selection and, said nicely, unfortunate execution. Let's add in some appreciation from a more effective market selection in the next scenario. This result shows a range of outcomes. Both the 5-year low scenario both the 5-year low scenarios are now accretive. The appreciation battles against the negative effect of the closing cost to a positive accretive result. The 5.5% cap rate investment at the high 5-year rate is still negative from an accretive standpoint. The most interesting thing is that the 6.25 cap rate investment at the high treasury range is almost perfectly indifferent to leverage. You can see that here where the return is almost exactly the same across all leverage levels. Use more or less, the returns don't really care, but I do. As a general rule of thumb, keep the leverage down in a modest range to reduce risk. This scenario actually could represent a BTR, deal structure build to rent, which is becoming more popular and has become more popular over the last 5 years. No value gain from initial rehab. We win if we pick a good market and be disciplined enough to execute at a high enough cap rate for the deal to work. All in all, though, this strategy may still require lower rates to post high performance given our assumptions. In our final scenario, we bring in the disciplined execution of embedded equity created from the initial rehab at acquisition. All scenarios are now accretive. The magnitude of the positive accretive leverage is highlighted in the 4.9% spread from 50 to 70 LTV in the best scenario to 2.4 in the worst. Higher leverage is rewarded when there's a good market selection and solid execution in this scenario. This could look like a scattered site value add play. Even without a major move in rates, this strategy shows promise in today's conditions. All right, stick with us. We are running here to the finish line. Let's draw some conclusions. Not a new one. The amount of debt you utilize is fully within your control, so make smart choices. Beyond its effect and current cash flow yield, accretive leverage also applies to total return, but requires consideration of additional factors. Limited accretive leverage opportunities exist today, primarily in scattered site value and value add strategies. A structural move down in rates could open up much more opportunity, so pay attention. And this one's a no-brainer. Good strategy that includes effective market and product type selection combined with disciplined execution is imperative in the successful investment in single-family rental portfolios. Thank you very much for joining us today. We'd love to talk with you more. Please don't hesitate to reach out at any time. We look forward to the conversation.